Welcome, everybody. This is John Rothe at Riverbend Investment Management. Welcome to this week's Big Picture Market Update. This is going to be for the week of December 2nd, 2022. So to start off this week, I want to talk about seasonality a little bit more in depth. I've talked about it briefly the last couple of weeks. I've shown charts like this that really represent the average monthly performance going back to the 1950s. And the purpose of this is to really show us where the strongest months tend to lie historically. And historically, the strongest months that tend to favor November, December, January is where you really get some strength in the market. And that seems to be what's starting to play out. We've had a good, strong November. December looks like it's lining up to be a strong month. And January looks like it's going to be a very strong month, which I'll show you in just a moment why. The other chart I've been showing is this 4-year presidential election cycle chart, which really just breaks down the 4 years between elections and shows us where that strength lies. We're here in year two. It tends to be the weakest period of time. And we just passed those midterm elections, and the market's starting to kind of rise in anticipation of year 3 and year 4. Now, the reason year 3 and 4 tend to be fairly strong is really investors get excited about politicians talking about how to fix whatever's going on in the world, whatever's wrong globally, whatever's wrong in the economy, and investors get excited, and it tends to push the market higher. So this is kind of where we are right now. We had more than a fairly weak year in year 2 here, but the market looks like it's starting to anticipate this idea of the seasonality trends starting to line up. And the reason we look at these seasonal trends is because statistically they work in our favor. Investors are always looking at where the odds lie, how can we put kind of the weight of the evidence and put the odds in our favor. And historically, these charts are looked at by a lot of investors, a lot of institutional investors, because they want to put the odds in their favor. And the reason I bring these two charts up is what happens if we combine them? Well, what's interesting here is if we go back here, historically, November tends to be the strongest month of that period during the year. But when we look at the presidential cycle and look at year 3, which is what we're actually about to enter, January tends to be the strongest month. 83% of the time favors a strong January. So this is why we're starting to get some excitement in the market. Investors that look at trends like this, and again, trying to put the odds in their favor, start to look at where history has benefited the market, and they start to allocate money accordingly. So if this trend continues, we can start to see a very strong January. The other thing that's interesting is year 2. What happens in year 2 when there's actually a negative rate of return, right? Year 2 tends to be the weakest of those 4 years, but what happens when there's a negative market? Well, going back to 1950, the rate of return has been fairly impressive for that year 3. And we can see the average rate of return is almost 25% during that period of time. So this is really what a lot of investors, a lot of money managers are starting to look at, and they're starting to get excited because the odds really are starting to line up that we might have a fairly strong 2023 going forward. The other thing to think about is we have our Santa Claus rally, right? The end of the year tends to be strong for the market. Historically, it favors a strong period of time, and especially favoring the end of December. And this is kind of, again, where the money's starting to go. Investors are starting to look at this trend that's happening in the market, and they're starting to get on board. They look at these historical trends, and they don't want to get left behind. So this is why we're having these rising thrust in the market right now, because people don't want to get left behind in their portfolios. You might be saying, John, well, I've heard there's going to be a recession next year. How does that impact the market? If you haven't seen this before, this is the 10-year, 2-year Treasury spread. It really shows us the difference between the 10-year and the 2-year Treasury yields. Whenever they're negative, it has accurately predicted a recession. We're negative right now. But what's to note here is, by the way, the gray lines here mark recession. The red lines mark when we're negative. And what happens, again, historically, is that just because we're negative, it doesn't mean a recession is right around the corner. It can take a year or two for a recession to actually form. And because of everything that's been going on with the Fed and the changing policy, it looks like this idea of recession might be being pushed back from next year into 2024. So if you haven't been following the Fed news, basically, the Fed has been worried about things breaking in the financial systems. We've already seen other central banks outside the U.S. intervene in currencies, intervene in their bond markets, because they're worried about something breaking within the financial system. And the Fed has taken notice. Our Fed has taken notice, And what they've done is they've started to change their policy a little bit. Before they were talking about being very, very aggressive on raising interest rates to now being a little less aggressive. So their foot, so to say, is still on the brake, but it's not pushing down as hard. And a result of that is this idea that, okay, the Fed's not going to be so aggressive that they're going to break something in the financial system, which is really what a lot of investors were worried about. So this potentially pushes out that recession toward really 2024 or later. And this is what a lot of forecasters are starting to look at and start to change their forecast going forward. So this is why, again, the market is getting excited about what's going on. If we look at our S&P 500 charts and where that trend lies, you can see here this red line is really our downtrend that we've been in for the year. And really every time we've hit the trend line, the market has reversed. Here we had our 50% retracement level, which tends to act as a support level for a lot of investors. And exactly the same thing this time, came down at 50% retracement level, and the market started to rally. We can see here we're finally breaking above that trend. This is an area a lot of investors were keeping an eye on to see if the market again would be rejected or if investors would start to push this market higher. And this is where we are right now. We still need a few days to really see how this plays out because we're just starting to break through this trend line. But if we can stay above this trend line, I think you're going to see a lot of those seasonal trend followers start to get aggressively into the market. And we could potentially push this market very high to even these previous highs very, very quickly. So the big theme is investors are worried about getting left behind, and they're looking at opportunities where to enter the market. And this is a great opportunity. If we break out above this trend line, this is a very, very positive sign for the market. The other impact that the Fed change in Fed policy is on the U.S. dollar. For most of the year here, we've had a rising U.S. dollar, which has had a negative impact on U.S. equities. Well, for the first time, we've broken that trend. The U.S. dollar is starting to fall fairly aggressively, which has been helping the market rise. So as long as this dollar starts to keep declining, and it's starting to break through some key technical levels, and people really don't want to be owning the dollar right now, this is going to, again, favor owning U.S. stocks. Let's look at value versus growth, because this is, I think, another very important topic. In the past, I've shown this chart, but it's been reversed. So I kind of changed the relationship just so it makes a little bit more sense. So here we have, whenever the line is rising, basically it means value is leading. Value's leadership name versus growth stocks. And after really the tech collapse, where technology was really leading and growth stocks really led the late 90s, we had that tech collapse. And what emerged is a change in leadership, which is what tends to happen when you have these big declines in the market. So during this period of time up to really the financial crisis, we saw value names were really where you wanted to be over growth names. Then we had the financial crisis. Growth names took over, right? Apple came out, iPhone, we had all these new technologies, apps, Netflix, Facebook, all these names that really pushed growth stocks higher. And this is where people wanted to be in the market. They wanted to own these emerging names, these technology names that were kind of innovative, they were exciting, and that's where really the strength was in the market. Well, now it's starting to change. It looks like we're starting to get a change in leadership again, which is what happens when you have these major down cycles and you start to emerge into a new cycle. You get a change in leadership, and it looks like value names are starting to change into the leading category, the leadership names in the market. So this could be interesting because we could have a period of time like something similar to 2000, 2008, 2009, where we had really strong leadership in the value names in the market. So we could see a decade or so of leadership potentially from value names instead of growth names. If we compare really the value stocks to growth stocks within the S&P 500, here in our blue is really our value stocks, red are our growth stocks. You can see since that recent low in the market how the difference in performance. Value stocks have really taken off. Growth stocks haven't. They've been just kind of playing along, catching up. All tides rise, all things rise with a rising tide, and you really start to see really this leadership and value starting to really emerge over growth stocks. We look at these kind of former darlings of the market: Facebook, Amazon, Netflix. Just look at how they've collapsed this year, and again, just really not much of a reversal in trend. People don't want to own these stocks right now. And this, again, is part of that switch over from that growth to value regime change. This is problematic for a lot of investors, unfortunately. So this is the S&P 500 weighting It shows us how basically the breakdown of the different sectors represent how much weighting is given to those sectors within the market. These are communication services. This is typically where your social media companies lie. Here's our actual technology sector. You combine you combine those. It basically means there's 31% of technology stocks representing the S&P 500. The reason this is important is a lot of, especially sector funds, obviously are going to be overweight technology, but a lot of mutual funds, they will try to mimic the S&P 500. So they'll be very aligned with what's going on in the market within the S&P 500. So you'll see a lot of mutual funds still have this overweight in technology until it starts to shift within the S&P 500, which it can take a couple years for that change to happen. But look at the value names. 2.25% to basic materials, financials a little bit better at 13%, consumer defensive 7%. Look at the energy. Energy's been a great performer this year. Only about 5% of the index makes up the energy sector. Industrials 8%. So a lot of people don't have exposure to these value names. They're instead overweight the growth names of the market. And as a result, they could be kind of left behind going forward for the next couple of years until this weighting rebalances itself as technology stocks continue to go down. So something to be aware of, because a lot of people still have their portfolios favoring technology, and that's kind of not where you want to be right now. If we look at the S&P weightings, the top holdings, look at this: all tech, Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia, just companies that have been just collapsing, and just really this is not where people have wanted to be, and investors don't want to own these names right now. So if you have any type of portfolio that mimics the S&P 500, which a lot of people do, you want to be wary of it, because you might be left behind, especially if value becomes that leadership name for the next decade. If we look at our sector rotation graphs, if you're not familiar with this, it's basically taking the various sectors that make up the S&P 500 and plotting it on a graph and breaking that graph down into 4 quadrants. So what happens is these tend to rotate in a clockwise fashion. And up here, this upper right quadrant in green, this represents the leadership areas of the market. They're showing the strongest relative performance to the S&P 500. Down here, this lower left quadrant, this represents the weakest area of the market. And these are areas we want to really just ignore, right? We don't want to be in the weaker areas of the market. We always want to be invested in the strongest areas of the market. And that right now is energy, financial, healthcare, industrial. The blue lines here really represent the second fastest growing area of the market, which again, value names, materials, consumer staples. Technology is starting to come up, but it's really just not in this area of favorability where it's favoring the strongest areas of the market right now. And then look down here. These are areas we don't want to really be involved with: consumer discretionary, communications, real estate. These are the areas that have really been weakest in the market right now. But this really just shows us that right now, the value areas of the market are the strongest and the leadership names of the market right now. So something to be aware of, again, because a lot of people have portfolios that are overweight technology. And right now, that's not where the strength is. So really, to sum up, the big thing we're keeping an eye on the next couple of days is this breakout in trend. Again, if we can continue this breakout in trend, you are going to see a lot of money re-enter the market, because those investors start to look at those seasonal trends and how those statistics lie up, and they're worried about being left behind. So that can really push this market aggressively higher going forward, especially if the Fed continues to keep its stance on being a little bit weaker, a little bit less aggressive, because those forecasters are starting to push that recession out to 2024. So potentially, again, a very strong January might be right around the corner if all these trends line up. So we're going to keep a close eye on how this breakout continues to play out. And if it looks like those seasonal trends and all that money is going to come back into the market over the next couple of days, how that starts to play out for the year end and how that's going to play for January. So that's it for this week. If you have any questions, best way to get in touch with me is by email, john.rothe@riverbendinvestments.com. You can also follow me on Twitter. I'm at John Rothe. I haven't been posting as much because of just really all the spam that's been coming through, but I've been trying to post charts occasionally. So probably once the new year comes around, I'll be more on top of posting charts here on a daily basis. But that's it for now. If you have any questions, again, please feel free to reach out to me. Have a great weekend, and we will chat next week. Thanks so much, everybody. Bye-bye.